financial argument. Follow us on YouTube.
Well, Eric, after a brutal week last week, it almost seems like we had a huge week for gold and silver this week, trading sideways most of the week, consolidating. As we record here Friday afternoon, silver is trading. It's been trading in a range here this afternoon, right between 1740, 1750. And gold also has recovered nicely here this afternoon, trading back above 1250. I've got a last about 1254. So it's certainly been nice to have see the metal stabilize here this week, Eric, after the just brutal beatdown they sustained really the whole week last week.
Yeah. Well, and that's also impressive too because we went over 98 on the dollar index, and there's been a lot of flows into the dollar with all of the European banking crisis stuff going on and the various turmoil in the market, and that we have been able to bounce off of a couple of direct attacks where either it was the cartel or just sellers that were pressured because of margin calls or what have you. We saw a couple of down spikes during the course of this week that were bought aggressively, and we saw reversals from them. And that's the kind of action that you see when a market is just kind of churning and all of the sellers that were hot to dump their positions largely have already dumped. And it just markets go through periods where they try to recalibrate and come to a new level, and that's what we're seeing this week. And even today, after 3 days of relatively tight trading, I mean, if you look at something like the 72-hour style charts that Kitco would do or what have you, it kind of looks like we have a heck of a lot of volatility and big moves and whatnot. But in the final analysis, silver has actually been contained to less than a 2% move today, and gold a little bit over a 1% move. And the market is just kind of biding time and trying to repair. I mean, even the miners, which have been one of the best indicators actually for the entire precious metals sector all year, they bottomed out in this week at least with respect to Tuesday's trading, and have just kind of struggled along all week as well. And here we are. We're only weeks away from the election. This morning, Zero Hedge published a really interesting article, Tyler, spotlighting what the Wall Street Journal had published. I think it was today. It may have been yesterday. Forgive me, I forget. But the article was written by one of the prominent members of the Wall Street Journal editorial board, basically outing the United States media for the circus that has been unbelievably biased coverage of this election. And again, I say this as preface. I'm not making a political statement that's partisan or anything. It's just the reality of the way the media has covered this election. And a perfect case in point is a Time magazine cover that had this kind of cartoonish picture of Trump with a meltdown, and it's just so over the top. That kind of stuff is not anything but an attempt to actually just steer the nature of the way the news is being presented. That's how intense the level of propaganda has been. So, we're in a last stretch where the markets are beginning to exhibit a lot of possible downside momentum, in my opinion. If you look at a chart of the S&P 500, we've gone through the Brexit shakeup, big downturn in June, July, bounce back as the powers that be and central bankers and all of the various minions in the banking system went to work to try to resuscitate the markets, and they succeeded. And now we've gone through roughly about a month now, just kind of going horizontal, and everyone's biding time and getting really nervous about all the geopolitical front and the frictions that are going on that level. And then the U.S. election. And I think that as the election draws near, we're going to continue to see pressure in the markets. And I'd also, as we discussed before we hit the record button, I think they're actually going to pull the lever and raise interest rates in December, just like they did last year. And that's going to probably upend markets eventually. It initially probably won't, actually. It'll also be similar like what happened last year because initially the markets actually surprised people. We didn't have kind of like a similar trading action to when we had taper tantrums in the responses to threats of raising rates. When they actually raised rates, the tone was, oh, okay, we're doing this because the economy's doing well, and here's proof. We raised interest rates, and that illusion, despite the fact that they realistically, we're only able to get like 13 basis points increase as opposed to 25, which is what they formally, hiked. I mean, I know I'm rambling here, but the degree to which everything is just kind of like a manufactured reality is getting pretty darn tenuous. And we've been at this theme before, and I think as we move towards the election, it's going to get even crazier.
Yeah, certainly volatility is going to be on the move up as we head towards the elections. I think that's a pretty easy forecast here this year.
Yeah. And if they do raise interest rates and if we have a lousy Christmas season, which I fully anticipate, even though the online sales will be much stronger than they've ever been in any given year, and there will be a lot of effort to interpret that as being an indication that the U.S. economy is strong, but it's not going to turn out that way. I mean, all we have to do is look at the labor market and how so many people are working multiple part-time jobs, and that's being tabulated as where the job growth is. And in reality, our labor market in the United States is just, it's really hurting. We're already in a recession, even though the powers of the be and the media and all that are not declaring it, but it will be declared. And all of this is incredibly bullish for precious metals. We have some pretty interesting things to report when it comes to what's going on with inventories. Why don't we just dive into that and also talk a little bit about as well what's going on with 90% and India as well. Switched to premiums in their importation of gold this week, just like what Dave Kranzler and I and you were talking about last week. So despite all of the day-to-day activities that make it look like this market is just trying to roll over, and everyone's biting and gnashing their teeth and fearful of what's happening with precious metals. It really does look like it's trying to bottom.
Yeah, and as far as the premiums and what we're seeing in the supply side in the wholesale market, gold and silver here in the U.S., really over the past week and a half, inventories have been pretty well wiped out. I mean, Silver Eagles are still pretty readily available, but outside of that, generic rounds, generic bars, they're anywhere from a week to 4 to 6 weeks delayed at the mints and wholesalers. And I mean, amazingly, it's even quite a bit of gold products, whether it's standard products like gold eagles, gold maples, gold buffaloes, 1 ounce gold bars, larger gold bars, some of the more semi-numismatic stuff like the Royal Canadian Mint Grizzlies, stuff like that. Everything's been wiped out and is a week to 2 out on resupply as the wholesalers put in their orders to the respective mints. And we've seen a continuation in the 90%. Premiums have jumped about another 40 or 50 cents this week. And not only that, inventory is hard to find in the wholesale market right now. Just 4 to 6 weeks ago, we were placing trades for 30, 50 bags at a time, and it wasn't impacting anything. 90% was readily available on the wholesale market. You could find it anywhere, and now it's hard to find even a bag or two of 90% silver face. And again, that's at $1.50 higher premiums on the wholesale market than we were paying just maybe 3 or 4 weeks ago. So.
And when you say bag, you're talking 1,000 face bag?
Yeah, 1,000 face bag. So. Whereas 4 or 5 weeks ago we were buying 30 to 50,000 face bags in the wholesale market and wasn't impacting the market whatsoever.
Wow. The premium was almost zero, right? I mean, it was almost at face
right,
for
exactly.
purchasers,
now paying,
which is
$1.50 higher.
Yeah.
Our purchasing team has been scrambling all afternoon to come up with like 3,000 or 4,000 face. It's hard to find anywhere.
That's one of the most important indications we've seen yet about what's going on, because it's really hard to interpret what the heck goes on at the mint, and they do their own inventory management issues and games and whatnot and strategies, and then all the authorized purchasers do that as well too.
Yeah, and we were discussing a little bit before the show began. The mint's only reporting about 500,000 Silver Eagles sold this week, bringing month to date to 1.95 million. And we're scratching our heads a little bit because it's a little bit not what we're seeing here in the wholesale market and the retail market, where, I mean, demand's off the roof. I mean, last week alone we had 2 separate days that were all-time sales records for SD Bullion last week, and they were both like multiples, like double the previous all-time record sales day. So
I bet you, Silver Eagle, that Bloomberg will run a story nevertheless. U.S. mint sales indicate that the precious metal space is seeing declining demand, and you need to sell your metal.
Well, even with only reporting 500,000 coins, we're still not for the month of October. We're 14 days into October, and the mint's reporting more coins sold in every single month going back to June. So it's still a big increase from what we saw in July, August, and September for sure.
Well, with that combined with what's going on with India and China being back this week, it all looks like the market's beginning to heal itself and ramp up.
I guess the one other thing that could be playing a factor in this past week is all of the Perth Mint's 2017 products came online. Well, I guess it's really over the past couple of weeks, because first all of their Rooster coins came online, and then their Kookaburras. So, I mean, they're not nearly the volume that a Silver Eagle does, but in total we're probably talking 500,000 or 1 million ounces of silver. So that definitely could put a dent in the Silver Eagle numbers if some of those investors that have been waiting for those coins, instead of buying a tube of Silver Eagles, they buy a tube of Kooks or Roosters or something else.
Yeah.
Or just all the generic products that are quickly evaporating.
As far as individuals who may be coming in with large new orders or large customers, what's the profile of the typical action you've seen this week, and does it suggest anything interesting as far as what's going on with demand?
I'd say over the past week, it really hasn't been big money. It hasn't been 6-figure, 7-figure money that we've seen earlier in the summer. Over the past week, it's been really your average Joe up to monster box buyers. So that's really what we've seen. Just there's been a lot of them.
And a much significant ratio of silver buyers versus gold.
Yeah, but I mean, gold demand is, like I said, gold demand has been off the charts as well. I mean, for the APs and all of the wholesalers to sell out of gold eagles, gold maples, gold buffaloes, gold bars, that just shows you the type of gold demand that the market's been experiencing the past couple of weeks as well. We had the Fed minutes this week, Eric, and then this morning Yellen was trotted back out in Boston. Let's talk a little bit about Yellen's speech this morning and the Fed as they prepare their MOPE and their propaganda here for December now.
Yeah. Her speech was interpreted as being somewhat supportive of the case and the argument that interest rate normalization can continue, and this is just this ongoing job owning and management of market sentiment that the Fed has been doing ever since 2008. She's speaking of ways that it could indeed be plausible that running the U.S. economy hot for a period of time, as if we're hot. She's presenting this in an abstract concept and describing the ways in which the Fed can approach policy on a going forward basis. That was basically the nature of this particular presentation, and it's almost surrealistic. I mean, she speaks a lot about how if businesses, quote, if increased business sales would almost certainly raise the productivity capacity of the economy by encouraging additional capital spending. I mean, this is almost like just throwing noodles on the wall and hoping things stick and speaking about things in abstract terms. Earlier this year, I think it was about a month and a half ago on one of our shows, we were talking a lot about the nature of models and how the Federal Reserve members, the FOMC members, collect their forecast estimates of where things are, and then they get together in this debate context of the FOMC meetings, and behind the scenes they're trying to compare and contrast how they look at the economy. And when we look at things like the Atlanta Fed model, for example, as an indication of where some of these individuals, these policymakers that end up making the votes that set interest rate policy, when you look at things like the Atlanta Fed model, and we've talked about that over the course of this whole year, actually talking about how crazy the policymakers are when it comes to their understanding of their economic goals and their forecasts. They truly are just grasping for straws. This morning, the Fed Atlanta model was halved when it comes to their estimate for third quarter growth, when earlier this year, timed precisely, be it coincidence or not, with the election cycle, they came out and had just unbelievably aggressive estimations of where the economy would be in the third quarter, fourth quarter, and next year. And we talked also about how the FOMC's 70% confidence interval, when Yellen, in the context of Jackson Hole, came out and started talking about where the FOMC forecasts lay for this year, next year, and the following year when it comes to the interest rate, the federal funds rate. The 70% confidence interval that describes the various forecasts of all of the economists that make up the voting members as well as just the entire staff of the Federal Reserve System, they'd estimate that the federal funds rate would be anywhere from, I believe it was 0.2% to 3.8% in 2018. And I mean, they really, truly are just grasping at straws. And these speeches, like the one today, are more indications of that. And the market participants are going to look at a possible raising of interest rates initially as something that's going to confirm that the Fed's smoke and mirrors act is all true. But over time, and particularly after the holiday season, shows the true nature of where we are economically. It's all going to translate into the stock market rolling over. I think we're going to see a really, really, really big equity market correction, and likely interest rates shooting higher as well too, just simply because of the fact that all of the stimulus that's been going on since 2008 is long in the tooth. Our economy, the United States, stopped growing in 2013 for all intent, or 2012 actually, for all intent and purposes. And this cycle, even just from the point of view of the duration of the economic cycle and the business cycle, as artificial as it is, it's also long in duration and very unnatural too. And then when you add on top of that the geopolitics and the U.S. election and everything that's going on, these plates are going to crash. It's just a question of when. I think 2017 is going to see a repeat of 2008. I don't know if it's going to be quite as big as 2008 initially, because the powers that be, the plunge protection team, the central bankers, and all of the various people within the establishment learned a very painful lesson when Lehman Brothers went down. And they're just as they were with Brexit, and just as they were with Deutsche Bank going and doing swan dives a couple of times this year where they came in and caught the stock and pushed it back up. I think we'll probably see a lot of that kind of stuff really quickly this time around. We've already seen it this year when it comes to those particular examples. And the problem is that the rot in the financial system, in the banking system, particularly in Europe, is so bad, I don't think they're going to be able to catch this fast enough.
Eric, do you think that's the plan B for Trump? Do you think that if Trump somehow is elected, that's their plan B, that, okay, we'll let it all just fall down, and we've been trying to prop this up for a decade anyways?
I don't know if I'd go as far as to say it's a quote-unquote formal plan B, but almost along the lines of, hey, if that's the way the cookie crumbles, that's the way the cookie crumbles, and the establishment will just make the most of it, or at least attempt to make the most of it, because to a very large extent, that's where our future lies no matter what happens, because of the fact that this artificial stimulus has gone on as long as it has gone on, and they can't continue to do this. When you have $14 trillion in negative sovereign interest bonds, that is an indication that, in particular, the European banking system, but it's not just the European banking system, and it's not even only sovereign bonds, it's also corporate bonds now too. The banking system is broken. Banks, at least commercial banks, not the investment speculator crazy financial system that we have now, but in commercial banking, you're supposed to be able to lend with a spread so that you can make a profit and sustain your industry. How do you have a spread when the entire yield curve is negative? The banking system is broken. It can't go on like this indefinitely. And we're going to have a crash. And I think that crash is next year.
All right, we'll wrap up this week's show there. Thankfully, we don't have too much negative to report in gold and silver this week, as we discussed. But yeah, some early promising signs in the stocks, and we'll see as we move ahead here in the next couple of weeks. If we have put in a bottom here over the last week to 10 days, and if we can start to move off of that bottom and start to gain some traction to the upside, again, as we discussed earlier, certainly we expect quite a bit of volatility here in the fourth quarter between all the chaos with the banking system, Deutsche Bank, and then throw in this massive chaos that is the 2016 presidential election. It's certainly shaping up to be quite the interesting quarter. All right, so for the Doc and Eric Dubin, thanks for tuning into this week's SD Weekly Metals and Markets.